The market is on a knife's edge. We're sitting at all-time highs, but there's a wall of event risk coming straight at us this week. So let's break down what's coming and how to think about positioning. Look, the tape looks strong, but the internals are weak. So the question you've got to ask yourself is, are we about to see a year-end melt-up, or are we staring over a cliff's edge? This explainer is going to break down the key catalysts, the risks hiding under the surface, and some potential trade setups for the next 1 to 2 weeks. Okay, first things first, let's get grounded in the schedule. All the action this week, and I mean all of it, is going to be driven by 3 major events. Everything else is just noise. We have a huge concentration of risk right in front of us. Tomorrow afternoon, we get the FOMC rate decision. Then, throughout the week, the market's heavyweights. We're talking Microsoft, Google, Amazon, and Apple. They all report earnings. And to cap it off, there's a US-China leadership meeting on the 30th. The 2 you really need to watch are the Fed and big tech. Let's be very clear about the FOMC. The rate cut itself, it's a non-event. The market has a 99.9% probability of a 25 basis point cut completely priced in. Nobody cares about that. What matters is the forward guidance. The market absolutely needs to hear a dovish tone about the path forward into 2026 to keep this rally going. Any kind of hawkish surprise will get punished, and probably hard. Now, let's talk about the engine that's been driving this whole rally, artificial intelligence. To really see the opportunities, you have to understand the entire AI value chain. It's a pretty simple chain reaction, right? It all starts with this massive, insatiable demand for AI from businesses. That demand requires incredibly powerful hardware, which in turn creates a major bottleneck for critical components like high-bandwidth memory. And of course, all of this new tech consumes a staggering amount of power, which points us directly to the energy grid, specifically nuclear power. 34 times. That's the estimated jump in demand for high-bandwidth memory, or HBM. It's a critical piece of the puzzle for AI chips. This is a classic picks and shovels play. You're not betting on the gold miners, you're betting on the companies selling the essential tools needed for the entire AI gold rush. So where does that lead us? Well, to specific companies positioned to benefit. You've got Micron, which is a direct play on that HBM demand surge. Then there's Energy Fuels, which is a key strategic asset. It's the only US-based uranium producer that can power this AI build-out. And you even have established players like NextEra, which just locked in a 25-year nuclear deal with Google to power its data centers. Okay, so while the AI story is strong, the market's foundations are definitely showing some serious cracks. You have to look past the headline numbers to see what's really going on under the hood. Look at this. We are seeing extreme complacency. The put-to-call ratio has plunged to levels we haven't seen since the 2021 market peak. That means traders are all in on more upside and they're not buying protection. This is a classic contrarian red flag. When everyone is this bullish, it's often a signal that a top is near. And at the same time, market breadth is just falling apart. Fewer and fewer stocks are participating in this rally. It's being carried by a very small, very narrow group of AI megacaps. It's like the generals are charging way ahead while the troops are falling back. That's the sign of a fragile market that could turn on a dime. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. So you've got this massive conflict, powerful bullish momentum on one side and some really ugly deteriorating internals on the other. How do you position for that? Let's outline the scenarios and the key levels you need to be watching. All right, here are the 3 primary paths I'm seeing. The bull case gets triggered if we get a dovish Fed plus strong earnings, targeting a breakout above SPY 690. My base case is for some consolidation, with the market basically chopping around and holding that key 685 support level. And the bear case, that gets triggered by a hawkish surprise from the Fed or a major earnings miss, which would likely lead to a break below 685. The bull case is pretty straightforward. A dovish Fed, continued strength in AI earnings, and positive Q4 seasonality could easily fuel a year-end rally. The levels to watch are a break above SPY 690 and NVDA holding 200 as support. What kills this thesis? A hawkish Fed or a big earnings miss from a name like Microsoft? Now, the bear thesis. This is where a market priced for perfection becomes extremely vulnerable to bad news. If that complacency we saw unwinds, the weak breadth means there's a vacuum of buyers underneath. A break of SPY 685 support could easily trigger a sharp, fast correction. This thesis is invalidated if the market just shrugs off bad news and keeps climbing. All right, let's talk potential setups. First, a bullish play on Micron. A call-debit spread lets you bet on upside from that HBM demand while strictly defining your risk. You're buying a call and selling a higher strike call against it. This lowers your cost and caps your max loss. The thesis here is simple. You're playing for a directional move on a core AI hardware theme. The idea is dead if they give weak guidance on HBM. But what if you think Micron just goes nowhere? Well, the options market is showing a huge amount of gamma concentrated right around the 220 strike. This can act like a magnet, pinning the stock in a tight range. An iron butterfly is a strategy that profits from low volatility, so it could be a good way to play for that price pinning scenario, especially with high implied volatility right now. And for a longer-term thematic idea, there's energy fuels. This is a strategic play on the critical need for domestic uranium to power the entire AI revolution. Using longer-dated call options could be a way to get exposure to this multi-year trend, exploiting the tailwinds from both AI demand and geopolitical supply chain issues. And a final reminder, this is not trading advice. This is a market update to keep you informed. Markets carry risk, trade your plan, manage your downside, and verify all your data. So the bottom line is this. The market is at a clear inflection point. You have a powerful, bullish AI narrative clashing with undeniable risks from weak internals and huge macro events. The question you have to answer in your own plan is this. Will the bullish trend hold, or will these underlying risks finally take control?